good. Thanks everyone who's joining. In fact, actually, I'll take this opportunity just quickly. There's something I just need to put into the chat. Just a little disclaimer. So, sorry, I just shut my email down. Just going to get it here. Okay, so just putting something into the chat. Make sure it goes to everyone. Okay. So it's just here in the chat. I'll read it out now as people are starting to come through. So just to be really clear what this is and what this isn't. So this is not a sales pitch or anything. This is our educational side of what we do. So therefore, there'll be no personal advice found during this workshop. The information should be taken as general investment discussion. And if you need personal financial advice, you should seek this from a qualified independent financial advisor. We're not tax specialists, although at Source Capital you can invest with your ISA, SIPP or SAS for people who know what those are. It's also important to keep in mind that past performance is not a reliable indicator of future results. And for anyone who's joined a bit late, you can see that in the chat throughout. And this just makes sure that we're keeping our principal firm happy on the compliance side. Okay, somebody's asking a specific question about source ads. That again is not the type of thing we'll be talking about today. So yeah, I'd just like to do a quick introduction of who I am, and then I'll get to introduce Craig and Mark, and we'll get into some of the topics today. But just to give you a high level of who I am. So my name is Stephen Wallace, Operations Director at Source Capital. I've actually been working in financial services for about 15 years across everything from investment banking to payments to consumer lending to peer-to-peer business lending and now peer-to-peer property investing. Yeah, I often feel that, say with Craig's book, I learned quite a lot, even though I've been in this industry for a while. And I often wonder how on earth are people supposed to know about this stuff if we weren't taught it at school? And if you haven't had a similar career to me, how on earth are you supposed to get the right information? So this is the type of thing we're trying to do with these sessions, is to broaden the discussion, try to educate where we can. And it's not like it keeps me up at night, but I'm an active investor myself across most areas of alternative investments, actually, especially the last 3 to 5 years. And I do wonder where you can generate income from investments these days. It's not necessarily the topic we'll get into, but dividends have been hammered this year. And if you didn't sell out before the crash, you might have had a hit to your capital. Precious metals don't generate income. Crypto is pretty wild west, so is day trading. And we might touch on some of those things today, but it might not be relevant. So with regards to these virtual roundtables, we're going to do them every fortnight. It's going to be different topics. The next one we're hoping is going to be about investing in watches, which is something I know very little about, but I've always wanted to know. So we've hopefully got a few people involved who can teach me and you a bit about that. Yeah, and so, yeah, the topics will always be broadly about financial education, personal finance and alternative investments, which leads us nicely into today's topic, which is Shaking the Money Tree. So thanks everyone for joining us today. So Shaking the Money Tree is written by Craig Iley, who you can see here on your screen. Craig was a co-founder of Atom Bank. He's also been there from the start with B North. He's got something like 4 decades, I think, Craig, of financial services and banking experience, and he's a successful author. Today, we're going to talk through some of the big discussion points in his book, Shaking the Money Tree, and get his views on other key topics in the banking world. We're also pleased to welcome Mark Lazenby, partner at Square One Law, to this virtual roundtable event. Mark and Craig have known each other for a long time, and I'll be asking Mark's views on certain legal aspects of what Craig's written about in Shaking the Money Tree, and also get Mark's views on certain themes which have been running through 2020. So, before I introduce, actually, we try to keep these as interactive as possible. We've got a few polls that we run. We did that last time for anyone who was here a couple of weeks ago. So just try to keep things interactive. Don't feel like you have to join in. But if you can just see, you'll see in a second, I'm just going to see if we can get a bit of a general idea. It helps us to understand for future topics. I just want to know which of these investment classes people invest in. So I think Craig and Mark, I forgot to tick that button last time. So if I tick that, hopefully this poll is now launched and people can see it. With this one, you can select multiple, and let's see if I start to see any answers coming through. Aha, it's working. Always good. Lots of business owners. Great. I'm always a big fan when I see that. That might help with our discussion today as well. Lots of people who invest directly into property as well. Always good. Stocks and shares, no surprise. There's almost half the people invest in there. Peer-to-peer property lending, I guess we've got some people who are familiar with what we do and what's going on in our industry. Crypto, quite a lot of crypto investors. Oh, they like the Wild West. Yeah, so it looks like direct property ownership and business ownership are coming out on top, with stocks and shares third. And then followed by peer-to-peer property lending. Yeah, very interesting. All right, thanks everyone. Yeah, we'll have a couple more of those. Hopefully keep everyone interested, and thanks for joining us on this lunchtime. It is live, by the way, so it's the 22nd of October and we are live. Okay, so right, without further ado, I think that's enough of me talking. So I'd like to introduce Craig. And Craig, we've only recently connected, obviously, and it was actually someone through our Source franchise who I met over in Hull last week, who said I should reach out. I've subsequently bought the Kindle version of the book. Remembered I prefer paperbacks, so bought that one, which actually, you know, just so even though I'm not fibbing, here's my copy. And I've also bought another one for our office. It's great. I think I mentioned earlier, it's extremely accessible for people who aren't familiar with banking. And even though I think according to Vets Football, I'm a veteran of financial services, I still learned a lot and it jogged my memory, which is quite nice. So firstly, I wonder if you could tell people why you chose to write this book.
Thanks very much, Stephen. Good afternoon, everybody. The reason I wrote the book was primarily because I don't think that the banking system that we have today in this country is fit for the 21st century, for the world that we are moving into. And I think to a degree, there's a possibility that we're sleepwalking into another financial crisis. We're already seeing large swathes of our communities being excluded from banking. But the one that concerns me most is business banking. In 1988, something like 40% of all bank lending went to SMEs, and today it's about 4%. And the SMEs are really important to us. You may think, well, why should I care? But you really should care, because SMEs, they're the wealth creators in our society. They create 2/3 of all new jobs. They're responsible for most of the education and innovation that happens. I'm not knocking the universities, but you spend a limited time in formal education. You spend perhaps 30 or 40 years learning on the job. But the big thing that we forget about business, and we never talk about businesses in these terms, is that they're very important to us for social cohesion as a society. Most businesses employ less than 10 people. Most of them are firmly rooted and embedded in the communities where they live and work. And they provide a lot more for our society than simply jobs. And I think it's important that we recognise that we need to provide banking services for the whole community. Now, in terms of why I wrote the book, I wanted people to get involved. I wanted people to understand what I see as the issues. And I wanted people to get involved in calling for change. But even better than that, I wanted people to get involved in being part of the change. Because the other thing that's happened most recently, largely thanks to the digital revolution, is that it's now possible to do things that we could never do before.
Yeah, brilliant. Thanks, Craig. And I suppose, Mark, is there anything you might want to add? I suppose, you know, being involved with an SME and seeing a lot of SMEs, I think, through your work every day.
Yeah, I mean, following on from the theme from Craig and his book, I would say what the SMEs want from accessing capital and from their banks is that relationship. It is people to understand their business and not to be remote. So there are other forms of capital people are exercising, where people get involved in their business or show a genuine interest rather than having a sales mentality. So I think the statistics that Craig's been mentioning on how it's reduced, and so 40% to, I think, did you say 4%, Craig, of business banking and lending to SMEs? And a lot of that will be because the lending's made up of different proportions in retail and individuals, but also the SMEs themselves are looking at alternatives. So they're looking at raising capital, whether it's venture capital, whether private equity, whether it's private syndicates. There's a lot more choice now. But the SMEs we talk to, it's all about relationships and a bit of continuity, not having a different relationship manager every 3 weeks.
Yeah,
there is more choice. There is some truth in that, but it's largely because the banks have chosen to concede it. It's not because they fought for that. It's about processing. It's about relationship, definitely. And we may touch on it later, but it's partly because the banks are now trying to pull together diametrically opposed business models under one roof, and it's very difficult for them to service SMEs, and they're just conceding ground because they can. But that's not actually good for society when you consider what a bank is and how it can impact us economically.
Yeah, brilliant. And yeah, I think we will. We're going to get deeper into all this, I think, a bit later on. But yeah, thanks for that, though, Mark and Craig. So yeah, I know it was one of the bullet points we put when we sent out the invite. I think when I was reading the book, there was a bit of a oh yeah moment when I read the bit about fractional lending, and obviously then applied that to what we do at Source with peer-to-peer lending, and how I thought crowdfunding was the same as peer-to-peer when I first got involved with it. So I was wondering, Craig, if you would be able to talk to that. What is the well, firstly, what is fractional lending, and how does it differ to how peer-to-peer works?
Okay, fractional lending, you've got to understand what a bank is. A bank is an engine designed to do two things. It's designed to expand the money supply and recycle liquidity. And in doing so, it's designed to enhance returns on capital. And the way that it does that is through fractional lending. Now, the example that I give in the book is, if you have party A who has £100 and he lends it to party B, and at the end of the year, party B repays £103, then party A has made a 3% return on his capital that he's employed. If party A decides to put his money into a bank instead, and a bank then lends £100 to party B, the return on capital that the bank makes is closer to 30%, not 3%, if it gets that same £103 back at the end of the year. And the reason it can do that is because it's not its own money that it's lending. It's lending its customers' money. And the only impact on a bank's capital is it has to keep a small amount of capital to one side in the event that that loan goes wrong. It doesn't actually go anywhere. It's either deposited with the Bank of England, or it's invested in gilts or various other types of investment. Just for the sake of the maths and the illustration, let's keep it simple and say that's around about 10%. That's roughly about right as it happens. So if a bank has £100 of capital, it can lend £1,000. If party A has £100 of capital, he can only lend £100. Now, if you think about that in a regional context and how that can impact us regionally, if you're based in, say, Wallasey, for example, and you are allocated a £50 million investment fund from the government, that £50 million can be spent and invested in your area. But if you have a bank that has £50 million of capital that it wishes to deploy in Wallasey on that area, it can lend £500 million in that area, and it can increase that exponentially and recycle that. And it's the difference of magnitude. That's really the thing that makes a bank special. Yeah.
Great, Craig. And I suppose so whereas peer-to-peer, whatever we raise, say, through our platform and others through theirs, that is the 100% that's, say, going to go to a property developer. We haven't got this leveraging aspect.
That's right. And obviously you can get a very good return, particularly in areas where the banks are not choosing. And property is a great example of that. Where the customers are less concerned about the rate and more concerned about accessing the finance from a reliable partner. And then crowdfunding is different again, because crowdfunding, you're getting equity usually, not always, but usually you get equity, and therefore your return is variable depending on the performance of the business over time.
Yeah, exactly. And that was the mistake I made 3 years ago. I thought they were one and the same, didn't realize that peer-to-peer is a loan, and crowdfunding, you are profit sharing with the developer. And unfortunately, the ones I tried to spread my risk, tried to diversify, do all the right things, chose different platforms, chose different parts of the country, and all of them have overrun, and there's no penalty fees or anything that I can charge. It's yeah, it was a lesson, that's for sure. And I suppose, Mark, just following on, I know we've had a couple of chats this week, but just to see, so do you think that this these types of different options are widely understood by developers and by you know, businesses, that there are other ways they can access finance?
I think they're becoming more understood. I think it depends on your sector and the age profile of the business. So startups, and certainly tech and young and hungry businesses understand the options to raise capital digitally. So crowdfunding, peer-to-peer lending, probably crowdfunding more. Just anecdotally, people are more clear on that on raising crowdfunding on crowdfunding platforms. I think in terms of peer-to-peer lending, I think there's been, you know, there's some well-known names out there, but I think there's also been quite a lot of private platforms that have started up to point their capital at particular sectors. Property is one of them, because you have the advantage, you can grant security, and you can get into the actual project itself. So I think people, certainly in younger businesses, people appreciate the ability to explain their project, because it's effectively it's financing a project, whether that's a startup or whether that's a property development. And you're getting people that are interested in the project. I think that's what people often want to see. You get people who are bought into your idea as opposed to selling you a product. Yeah. So I think it's happening for more mature businesses. I think it's certainly less used. Whether or not it's less known about, I think they just think it's more applicable to startups, would be anecdotally what I see. Yeah.
Okay. No, great. Okay, excellent. We've got some other things. Obviously, I'm mindful that we said 45 minutes. We may overrun. We slightly overrun last time, but we won't keep you any longer than we should, really. Sorry. So second poll we've got. So yes, it's following on from that first one. Again, we're just trying to. Well, I'm just trying to understand. You know, when I mentioned at the start, you know, that it's hard to generate income at the moment. I wonder, of those investment classes people mentioned in the first question, where do you put the biggest proportion of your money? And I'm just going to launch that one as well. Again, don't feel like you need to join in, just to try and keep everyone engaged. And obviously, I think I mentioned earlier, the chat's open as well. If anyone has any questions, we'll try and get to those as well. Yeah, I'll just let that poll run for a minute. Yeah, and I suppose it might not be too surprising here because they require bigger amounts of capital. I think that's what we're saying, Craig. I'll be amazed if this isn't your own business and direct property ownership. I'll be amazed. Yeah, and that's the way it's looking. Yeah, and actually, so yeah, maybe people, I don't know if anyone's familiar with this term I came across, moonshot. So, you know, I think it was old Nicholas Taleb, you know, the Black Swan guy, who wrote about it. I think this, was it a barbell, where he says you heavily weight one area, which you think is solid, good security, and it's within your control. But then you put a bit of money into these moonshots, which if they do well, they'll do really well. But you're just careful that you would only ever put a tiny amount into that. And actually the fact that there's a bit of money here in ETFs and crypto and things like that, and precious metals, yeah, just maybe shows that people like the things that are within their control. Maybe. Isn't too surprising. Okay, another question that that I put on the invitation, Craig, and I know we said, you know, feel free to caveat this as much as you want, but what do you think? It's been in the news a lot at the moment about potential negative base rate. What do you think might be the ramifications if that happens here in the UK?
Well, negative interest rates are really just a continuation of the basic theme that if you reduce interest rates, you stimulate demand, you encourage people to take money out of the bank and get them to spend. And the purpose of that is to create inflation. Now, we tend to think of inflation as the devil incarnate, but in actual fact, if it's controlled, inflation's very good for us, because what it does is it inflates asset values, such as property, for example, But the big benefit of inflation, which most people don't realise, is that it erodes debt. If you have a society that's very heavily indebted, the way you get out of that is to create inflation. And just to give you a very simple example of what that looks like, if you bought a house in 1960, for example, and you paid, say, £3,000 for it, or you had a £3,000 mortgage to buy it, and that house may well be worth £500,000 today. Now, the asset has inflated in value, but at the same time, that £3,000 mortgage that you took out, if you fast forward to today, what represented a 25-year commitment to you at that time, you can probably now pay off with a month's salary. And so that's why it's important. Now, negative interest rates are basically a continuation of that idea. They're untested in the UK, although they have been used in Europe. My concern with negative rates is that when a bank lends money, it needs two things. It needs a certain amount of capital, but it also needs customer deposits, because that's what provides the liquidity for its business. And if you find that people decide, I'd rather keep it under the bed or spend it than pay the bank 0.25% or whatever it happens to be, just for them to look after the money, then what that could do, that could impinge upon the bank's ability to lend, and that could create some problems. So I'm not 100% certain that negative interest rates are that desirable. Although, as I say, I think that's the basic theory behind it. But yeah. I should say I'm not an economist.
Yeah, and I think, Mark, this is going to link into the chat we were having earlier in the week, where, you know, what tends to happen when there's some people aren't sure how things are going to go, and there's a lot of uncertainty, is that, for example, you told me about this property deal that came across your desk where you couldn't find a solution. But maybe you could explain what that was a little bit, but also, do you think that's linked to what's going on this year, or do you think that this is just the way that things are going anyway with traditional lenders?
Well, that deal I was explaining to you was there was a property development deal where there was some extra funding needed, completely unencumbered, and there was effectively a loan requirement of 10% loan to value, and all of the mainstream lenders turned it down. What you know, for some reasons, because it's not at the start of the project, but other reasons that were given were we're not taking on new lending now that doesn't increase the quality of our loan book overall, which was frankly a very strange response. And I think people are becoming very choosy, because it wasn't the quality of the development, because it's as soon as it went on sale, it sold out in 10 days. It was 8 properties. So it wasn't the quality of the underlying asset. It was a policy decision on not wanting to get involved, I think. In terms of the sort of negative interest rate, I think I think my concern, I understand what Craig said, my concern also is sentiment, because it provides a negative sentiment. I know it's an encouragement to lend, but it provides a negative sentiment, so people don't necessarily want to borrow. And for existing products, it makes and loans, it makes very little difference, because they've probably got a floor in the products anyway, so they're not going to go below 0 or whatever the floor is, or they'll be on fixed rates. So it doesn't, you know, it doesn't reduce existing borrowing costs particularly. And I think the negative sentiment means people don't actually want to borrow.
I could take a guess as to some of the things that would drive that kind of decision. I mean, I noticed there's a question from Andrew Noonan as to why lending criteria and mortgage criteria are changing quite rapidly. When I said that a bank has to keep a certain amount of capital to one side when it's creating money using the mechanism of debt, and I used the figure of 10%, it's actually a very complicated calculation. And just to give you an idea of how complicated that is, and particularly relevant for property, if I were to lend as a bank £1 million to a property developer, and I was to lend £1 million to somebody who wanted to buy the house after it had been developed, I would have to keep 5 times as much capital to lend the same £1 million to the developer as I would to lend the person who actually purchased it once it's built. And so in the environment where capital is constrained, or perhaps deposits are becoming constrained, one of the things that a bank will look at is, how can I deploy this capital and make the most effective return? And that could well be driving it. In fact, post 2008, I think the property development sector in particular, but property generally, was the one that felt the effects of that most quickly.
Yeah, and I know that's I should have made a specific question about that, because I remember, Craig, when I read that in the book, and I was like, I co-wrote an ICAP at a bank, for anyone who knows what that is. It was hell, basically, and I was involved in a lot of that modeling and figuring out risk-weighted assets and all this other stuff, which determined our capital requirements and all this other stuff. So yeah, it was one of those where I'd been out of it for a few years, but I was reading Craig's book and I was like, oh yeah, geez, I remember all that.
So again, if you say on 3% margin, for example, if a bank makes an average of 30% return on capital, if it's lending as an average, a blended average, it can either make 5% by lending it to a developer, or it can make 40, 50% by lending it to a retail customer.
Mm-hmm.
Now, in that scenario, it's not a difficult decision for a bank to make where to allocate its capital. It's not necessarily the right decision for the rest of us, but it's not a difficult decision for them to make. And bearing in mind they have their own internal capital hurdles as well. A bank's usually made up of a number of divisions, and each of them have an internal rate on return that they need to achieve. It's usually about 12 to 13%.
Yep.
And none of our big banks are currently achieving that. None of them.
Yeah. Yeah, I think that's a really good answer for Andrew's question there. Let's see who's Paul's. Why would the bank need 5 times holding if lending to a developer? Maybe Craig, can you just repeat how you explained that?
Right. Okay. I'm happy to take this offline. If you want to email me separately, Paul, or give me a call. But the short answer is, when a bank lends money, it's not its own money it lends. It has to keep a very small proportion of its capital to one side. And the reason it does that is against the possibility that that loan will go bad. The amount of capital that it needs to keep is decided by an international accord called BAL. And this is all in the book if you're interested. Now, the BAL Accord determines that certain types of risk are higher than others. And it just happens to determine that property development is 5 times higher, for example, than a residential mortgage. There are lots of different elements within that, but that's what it says it is. Now, I get the reason for the confusion, and the confusion is probably coming from the fact that as a developer, when a bank lends you £1 million, for example, it probably lends 50 to 60% of the gross development value, and it will do a full development appraisal, and you will have architect certificates and a quantity surveyor controlling things, and it will have a full suite of collateral warranties. Whereas at the same time, it would lend somebody up to 95% on a residential mortgage against nothing but 3 months pay slips. So what it takes into account is the risk, but unfortunately, BAL doesn't take into account the way that the risk is analysed. It's a bit of a binary thing, unfortunately.
Yeah, no, that's really interesting. Actually, obviously, one of the things which pops into my head related to what we do with that is, so obviously we want to lend to property developers. We've chosen this is the area we want to get into. So there's no confusion for us. It's not, should we do this or that? We've decided we want to lend to property developers, but not just any property developers. We only lend to our own network. So these are people we've trained. We got to know them. There's 115 or 120 and counting around the UK. We are bringing that deal flow. That means we can diversify across the country in different projects, different terms. But we know these people, and our intention is to lend to the good projects. And then it's just a case of putting it through our credit risk policy and our models. But yeah, okay. So Craig, I think let's jump onto something which is a bit different, but was one of my, I love sort of, really good takeaways. So and it links back into what people were saying about how there's a lot of business owners and people who invest directly into property. So what is the difference between a plan and a strategy?
All right. Well, when I was writing the book, one of the things that jumped out to me about some of the things that I'd seen in the past and how some problems can arise, is that people in management don't always understand, or they don't distinguish between a strategy and a plan. A strategy is an overarching set of goals or objectives to take you to a particular point. And that's usually long term. It can be medium term, but a strategy is usually a fairly long term thing, and it's flexible and it changes. A plan is a short term set of steps to take you one step on that journey. And a strategy is never a single plan. If a strategy needs to change, it adapts. If a plan needs to change, you bin it. You don't change a plan. That's where we get the expression plan B from. And what I found over the years was two things, really. One is, if you sit in a management meeting, and by all means, please try this. If you sit back and you listen to the conversation, if you're having a discussion about strategy, how often that discussion will switch to individual steps. For example, analysing the sales funnel. And when somebody is being challenged about a plan and they're not achieving the plan, how the discussion then switches around to, but the strategy is this. Now, it's okay when it's a relatively small business, you can manage that. But in a bank, for example, it tends to drive very, very poor behaviours, because strategy is the preserve of the board of directors or the senior management. And the strategy isn't well understood by the teams. And the teams get a short-term plan that they have to implement. And what happens is the plan becomes a bit of a sacred cow, and it drives very poor behaviours. So, for example, in banking, the plan would be, for example, you have 10 meetings a week, you have 8 sales leads a week from that, you have 4 that move to a deeper discussion, and 2 of which will result in a sale, of which you have to generate X amount of commission. That's fine. That's a plan. But when the plan is the holy cow, then basically what happens is bad behavior creeps in. You don't understand that the strategy is about deepening a relationship with the client, retaining that client, and expanding the level of business that you do with that client. It's simply about the plan. And when you have a look at things like mis-selling, like PPI, for example, it's just disastrous for a business.
Yeah, I couldn't agree more. Mark, I'll get you to jump in on this one as well. Do you see that sort of that confusion as well? And you know, I suppose companies not keeping their eyes on the main, you know, the strategy.
Yeah, I think when we sit alongside some of our clients in that sort of boardroom environment or strategic environment, it's making sure that you understand that longer term goal, and as Craig says, and then dividing it into various steps, that sort of bite-sized steps where you put your plan to. But if you don't understand the long-term goal, or you know, the core values, or however it's presented for the business, I think your plans get lost, as you know, the sacred cow, as Craig says. But the plans, people just go to that and say, well, I've achieved it. And you're like, well, you're not really following the ethos of the business. You're not achieving what we want, which probably should be long-term growth or investing in long-term relationships. But if all you're doing is ramping up how many people you sell to, then that probably doesn't create a long-term relationship. It creates a sales board and a churn, which is actually completely the opposite to the strategy, if you think about it.
Yeah, excellent. Okay, so
and that's culture, and that's where bad culture comes from.
Was it culture eats strategy for breakfast or something? I think I once came across. Yeah, what happens when the boss isn't there? Yeah. Okay, so I think we'll jump into the third one, the third of our polls. So this is a bit simpler. I was talking to a few people about this recently, about how tax efficient people are with their investing. There's a lot of smart things you can do with a pension for those who understand what SIPs and SASs are. Same with ISAs if people are maxing those out. But what I tend to find is that people aren't necessarily aware, or they're not utilizing these vehicles. So the next question is just, how do you invest? Cash, ISA, or pension? It'd just be interesting to know how people tend to invest when they do invest. Looks like I may have had my crystal ball nicely ready. It's predominantly cash. Fair amount of people investing through their pensions, similar with an ISA, but cash is coming out on top. There you go, Craig, linking back to what we were talking about with is it worth keeping your money in the bank anymore? Yeah. Yeah, really interesting. Yeah, fascinating, that one. I did wonder. Everyone obviously reads the same news articles I do. Yeah, okay, brilliant. Thanks for that, everyone. Yeah, cash easily out on top on that one. Okay, right, and I think, yeah, the next one, I think, yeah, Craig, we were talking about this, and so linked to banks, and yeah, this is my previous life a number of years ago. So taking us back a bit, because people are seeing similarities between 2020 and 2008-9. So just your opinion, actually, why do you think the banks had to be saved in 2008-9? And how worrying is their too big to fail status for society and for all of us?
Well, that really revolves around understanding again what a bank is. So if you ask a bank, if you ask a banker or a number of bankers what business they're in, the majority of them will probably say the money business, or the ones who want to be clever will say it's a people business. But actually, banks are in the faith business. Banks are in the faith business because money does not exist as a store of value any longer. And it hasn't done since the 1930s and since the UK came off the gold standard. And I think it was 1973 when the Americans came off the gold standard. Yep. It's purely a faith or fiat-based commodity. And it's literally created out of thin air at the stroke of a pen. Now, the thing about faith is it's a binary equation. You either have it or you don't. So if you let one bank go to the wall, that becomes an issue for many banks around the world. And they're all interconnected as well, by the way. So what happens with your money in a bank, if it doesn't lend it out to its customers overnight, it's lent out on the international money markets. And that is another source for banks of liquidity. And if that seizes up, that faith has evaporated. And then basically all of the banks have a problem. So if you go back to 2008, the banks literally run out of money because they have to continue to get liquidity in to meet their ongoing liabilities. Prior to 2008, RBS ran out of money every day for a week, every single day.
Crazy. And didn't you say they were the biggest bank? And sorry, Craig, you said they were the biggest bank on the planet by some metrics at the time.
Yeah, depending on how you measure it. At that point in time, they were the biggest bank in the world. Whoa. Now, if you think about the size of the banking industry, the reason it all became so toxic, if they were lending money out and they were buying into investments, what happened with the subprime mortgages in America, they created what they called synthetic derivatives. Don't worry about the fancy language. It basically means they cheated. They bundled a number of different types of debt together, and a small element of that, and it was only a small element, was effectively bad debt. But because it was opaque and the investors couldn't see what was in that, they lost faith in the whole system. And so nobody was lending any money. Now, the banks themselves at that time, they weren't insolvent. They were illiquid. But if you can't get liquidity and your business is a cash negative business, which your bank is, it very soon becomes an insolvency issue. And I believe that there were discussions going on in the UK and Europe that every bank in Europe should be nationalised at the time of the financial crisis.
Maybe we'll save that topic for another day, whether that's a good thing or a bad thing, because I think this leads into something that I actually stumbled across on the 12th of October, that B North raised a further £1 million as it neared its banking license. So Mark, I think this is maybe something that would be interesting to hear from your side. So what are the challenges of raising finance in 2020? So both from I suppose, a legal perspective and then from an applicant perspective, how easy or difficult is it?
I think you'd be surprised that depending on the business, for example, so private equity funds, there is a huge amount of cash. And at the moment, that has been recently raised by the funds and hasn't yet been deployed. And certainly over the last 6 months or so, they've had very little opportunity to deploy. So So there has been a huge buildup of cash that had been expected to be deployed over the last 6 months that hasn't. So you're seeing quite a competitive environment for the private equity houses, in that there's less, because of the challenges businesses have, there's less opportunities, and a lot of the houses have cash that they need to deploy. What that means is prices are weirdly going up in a challenging business environment where there's a good business. So I think there is opportunity for raising private equity funds. There continues to be opportunities in terms of venture capital, so earlier stage businesses. I think there is less opportunity from the mainstream banks if you're trying to raise debt. I think they're just not interested as much as they once were in providing solutions. So the people are looking more and more for alternative providers of finance, and as you mentioned before, so peer-to-peer lending, crowdfunding, and what have you, but also private arrangements. So there's more and more syndicates of high net worths that are coming together to provide solutions. So there are opportunities to raise, I think, but it entirely depends on business sector. There is a lot of interest, as you might expect, in tech companies at the moment, certainly in med tech. But that's born out of where we find ourselves in the pandemic at the moment, I suspect. So there is actually a lot of cash around for investment, but the amount of opportunities for those investors, I think, are fewer than they have been.
Right. Okay. Yeah, that's really interesting. Yeah. Thanks, Mark. So yeah, I think we're sort of starting to approach the time that we were saying we would cut off. But there's one thing, Craig, I know it's at the end of your book, but I've worked with German colleagues quite a lot. I've spent a bit of time in a few of their cities for work, Frankfurt and Berlin especially. And I know you mentioned about the German model in the book. Can you maybe explain what that is?
Yeah, basically, we used to have this in the UK. We had a tiered banking system, and they still have it in Germany. But the tiered banking system that many of you will remember in this country, banks used to lend money to businesses, didn't do a great deal with, for example, residential mortgages. We had the likes of the Co-op and some smaller lenders, and the building societies were the ones who provided finance for property, and they were structured slightly differently. Now, the reason that that's beneficial is, if you take an example where banks are struggling, to be fair, if you take a large multinational bank, say HSBC, and I'm not picking on HSBC, by the way, it's just an example. They may have, say, 5 classes of customer. They may have retail customers, investment customers, international customers, SME customers, and large corporate customers. Now, if they're managing their business for the benefit of their shareholders, if they don't fancy one of those sectors at some point, they'll just withdraw and concentrate on the other 4. And that's a very sensible strategy as you would want a board to manage your investments. The problem is that it's not good for society if that happens, for reasons that I've mentioned earlier. In Germany, for example, they still have very regional focused banks, and they have sector focused banks. And for example, if they have a bank that's focused on lending, whether it be to property clients or whether it be to SMEs generally, if market conditions are difficult, they can't just walk away because they don't have any other customers. And so they have to be more supportive. They have to be more involved. They have to understand the risks better. They have to be more collaborative. Now, you can't just do that in the UK at the moment. The reason you can't do that in the UK is because what we have allowed to happen in this country is we've allowed 4, effectively, well, call it 5, but 4 main players to effectively close down all the competition by buying them, taking them over, or put them out of business. In Germany, they have a state-owned investment bank called, I keep wanting to call it KFC, it's not KFC, it's KFW, and it sits between the banks and the market. So they can raise capital and deposits at the same rate as a large bank like Commerzbank or Dresdner, for example. Whereas in the UK, a small bank couldn't raise capital at the same price as Barclays or HSBC.
Okay, yeah, that's fascinating, Craig. Thanks for that. So I've got one final poll for anyone who wants to stay involved with these. Yeah, and again, it's something that I suppose ties back to what I think at the start about, you know, the difficulty, and it was the theme of our last roundtable was how to generate income from your investments in 2020. And yeah, it's what I suppose getting a bit of a sentiment of that faith as well, Craig, that you're talking about. You know, if people have investment funds ready but not invested, what are the key reasons why they're not deploying them? So I'll launch that as well. This is one that I'm particularly interested in. I think there's probably never been more opportunities out there, but yeah, how to sift through and decide what's right for you personally as well. You know, like I said at the start, there's no personal financial advice or anything here. This is a general discussion, but it's the things that we're interested to know. Yeah, so waiting for the right opportunities coming up high, so it's keeping funds accessible. Yeah, we don't obviously know what's going to happen, but yeah, actually, I didn't ask you, Craig. I was going to ask about bank bail-ins because I was reading about that again today. You know, so if if the financial services compensation scheme, if you got any amount over that in Cyprus, was it, and in Greece, those amounts have been turned into shares in the bank.
Yeah. So this is another unprecedented advantage that we as a society give to banks, and I believe we should. By the way, this is not about bashing banks; they're very important to us. But in return for the protections that we give them, there should be a social element, a social dimension to their work. The Financial Services Compensation Scheme basically covers any customer deposits with a UK regulated bank up to €100,000. You've seen it vary between £70,000 and £80,000. The reason it varies is because it's in euros. But in reality, in the financial crisis, there were many people who had much higher sums deposited with the UK banks, and they didn't lose any. The government effectively underwrote all of it. In other countries, that wasn't the case. In Cyprus, I think the figure was €300,000. When their banks struggled, any customer that had more than €300,000 on deposit, 47.5% of that excess was simply taken off them, and it was used to recapitalise the bank that it was invested in, or the banks that they were invested in.
And the unfortunate situation I heard was, so that obviously wouldn't affect a huge amount of people, but there were people who sold their house on that day, and it was sat there for, it was about to be moved, but it just unfortunately wasn't on that day. Stuff like that is just bonkers. I think it's written into our law here though as well that they can do it. But again, don't quote me on it. People should go off and do their own research. It's yeah, interesting times. So right, we have slightly overrun. I'm going to wrap up in a minute, but yeah, I suppose Mark or Craig, is there anything else you think that we've missed that would be useful to tell people, or do you think obviously I'll tell them in a second how they can get in touch?
Yeah.
Anything you think we missed?
Well, there's lots of things that we could talk about, but for me, it's about getting people involved in the debate, the need for change, and there's a lot going on. Most of the people on this call will be from various parts of the country. We talk about regional levelling up, the Northern Powerhouse, or a devolution solution for Wales or Cornwall or whatever. You can do much more than you think. So please get involved and please get in touch.
Yeah, great. And Mark, anything else?
No, I think I think I would just reiterate that there are a number of alternatives to traditional bank financing for projects, and a lot of them allow you to get closer to the underlying asset and the business itself. So that brings a lot of opportunities if you're an investor. On the other side, if you're an investee or the borrower, then again you can find alternative sources of capital, and often you can find people that are genuinely interested to try and help you by using those. So there is more advantages than just the capital. Yeah,
couldn't agree more. Yeah, everything's still a relationship business, right? Yeah. The best ones anyway. So so thanks, Craig. Thanks, Mark. So I guess people can find you on LinkedIn. They can connect that way if they want to hear more. Or obviously, I think for those who are here at the start, here's the book. That's what it looks like. You can find it on Kindle and paperback. You can get it on Amazon. That's where I found it. Mark from Square One Law and Craig Iley as well. thanks very much. Thanks everyone for attending and giving us your Thursday lunchtime, and hope to see you on one of these again soon. Thanks everyone.
Thanks, Stephen. Thanks, everyone.
Thank you.